The Fed is slowing down the repo intervention, and curiously, this coincides with the drop in the stock market today. The Fed had yet to acknowledge their role in what happened with the stock market overall, and of course, they never will. But we can certainly sit here and point the finger. Ultimately, it doesn't do much to change the situation. CNBC, Bloomberg, and every other network are not going to talk about it. Their advertisers are loving this. What's most important is that people are seeking alternative data, which would give them a more well-rounded perspective on what's actually happening. But why bother? Just buy, right? You came here for the truth, so let me unveil that for you. Today, we are going to look at what's happening with the Federal Reserve. We're going to talk about what's happening with the repo situation, with QE4, with the money printing. Then I want to talk about what's going on with Hong Kong. I've got some info here about debt as well. A lot to get into, not enough time, of course. Let's begin with this. You're looking at the S&P 500, and the red line is the 200-day moving average. And apparently, we have never seen a divergence like this before. I don't know if, how this far that goes back, but at least in this case here, what we are seeing is that it has gone to a level we have not seen simply because of all of that intervention. There is no reason to worry. Risk is on the table, and you can see in this case the irrational exuberance alive and well. Most people would think this is a good thing. Stocks are going up, my 401k is going up, assets aren't appreciating, and the Federal Reserve is willing to backstop any losses. How could this possibly be a bad thing? I see the comments all the time, I see the articles, but they don't understand the repercussions. They don't get why this could be bad, and if they only understood just a little bit more information, of course, it would all make sense. I wanted to look at what Guggenheim had to say because it is quite true. Guggenheim's Scott Minerd sounds the alarm about markets as that we are in the ludicrous season. He said that the low yields in credit markets are disconnected from economic reality. I mean, come on, you've seen negative yield at around 13 trillion globally right now. There's a problem with that. There is something very, very wrong. And then he had this to say: I have never in my career seen anything as crazy as what's going on right now. We're in the ludicrous season. They have gone into such abnormal territory with the Federal Reserve and every step of the way. He talks about it in an interview that is located on this page here. It's about 9 minutes or so. If you want a little bit of that breakdown, of course, you can see it here. But essentially, he's just saying that what they're doing, the way that they're going, is not sustainable and it's not healthy. And most investors do not care that it's not healthy. They simply want to see their portfolio gaining every single year. If it goes down just a small little bit, they start crying and yelping and hoping that the Federal Reserve will step in. Somebody do something. Now look at what's happening with the term repo operations. Something that we have been told was taken care of a long time ago. And what's going on today? Well, you know what? We're going to have to continue this for a little while, and it's just going to go on and on and on. And it continues to be oversubscribed. In a time they're telling us we're going to be reducing, that's the new thing, they're going to be reducing the amount that they're pumping into the system. It's getting oversubscribed. So they don't want to acknowledge what's actually going to happen. The market requires the liquidity of the Federal Reserve, and simply pulling that back isn't going to fix the problem. They need to actually resolve it, but they're not willing to do so. On the New York Fed website, you can get the details and see what they've done. You could see it at the bottom here. They got the monthly summary, and essentially they started to reduce all these numbers. So, it's broken down, the term repo operations, the overnight operations. There's a whole bunch of detail associated with that. You've seen me cover it here before, but essentially now they're lowering their numbers a bit. It's still big numbers, but they're coming down. I don't have all the previous and the current in front of me here, but essentially just know that they're reducing them. This is a chart from UBS. Federal Reserve total assets are likely to keep increasing indefinitely. And we already know that. That was already discussed. I think it was Jerome Powell who had said that. Essentially, that they need to persist in growing the balance sheet in order to keep interest rates down. We've talked about the open market operations 1,000 times before. Here you could see the repo and reverse repo operations. They tell you one thing and then they're going and doing another. They're saying that everything is fine, everything is taken care of, we've got it handled, and yet oversubscribed all the time. Always keep your eye on this page, if not every single day, every few days, because you're going to see how this all plays out and you could see it for yourself. It's all documented here just to give you an idea to look at what was submitted, what was accepted, and if you see towards the bottom, it's basically double the amount that they need. So there is heavy demand for what the Federal Reserve can supply, and yet they're just now shrinking that number as if that's going to fix it. I don't know what the heck is going on. Now this chart here comes from Guggenheim's more recent report. The pace of Fed balance sheet expansion will slow. So this is coming out of multiple sources in what they say is going to happen, but if there's an event that's triggered, this is obviously going to change. Yes, they're making that statement. Federal Reserve saying we're going to slow this down. This is what we're going to do. I don't know how long they're going to be able to keep that up for, but this is what it looks like. In the second point on the right-hand side, while the Fed has sought to dispel the notion that this was QE in disguise, many investors have pointed to the Fed balance sheet growth as a catalyst for strong risk asset performance in recent months, and we have clearly seen that. I showed you right at the beginning. The Federal Reserve provides these reports, and I think everybody should always take a look at them because the charts are very telling. You're going to be able to see really good data, and it's available to you for free. If you check out the New York Fed website on a periodic basis, you're going to be able to find out the newest information. They're going to give you all of that data related to debt, and it is obviously extremely important. I'm not going to harp on it too much, but I will touch on some data that comes from there. I'll leave the link, of course, as always, in the description under the sources. You could see right here from the report household debt and credit developments in the fourth quarter of 2019. I wanted to point to something at the very bottom. We're looking at the amount of delinquent debt because obviously that's incredibly important. Of the $669 billion of debt that is delinquent, $444 billion is seriously delinquent. That's at least 90 days late or severely derogatory. Now I know that when you compare it to the total debt, that's a small percentage. We got that. But the trend is that it's heading upward. And that's never a good sign. Also, this debt, when you think about it, is always attached to everybody's favorite derivatives. That's right, the derivatives are hanging above this financial system. If you've read the Money GPS, you know this upside down pyramid. We got those derivatives hanging above. We got the fractional reserve in the middle here, and of course the real assets being at the bottom there. And this drawing is obviously not the scale, but the derivatives are very important because they topple the entire system. We saw what happened back in 2008, something that should have been able to be held back. Well, okay, no worries. It's all in the subprime. We don't have to really get into it any further. This is going to be handled. We'll just take control of those derivatives and everything's going to be a-okay. Well, you know what happened. Auto loan delinquency surge, 90 days plus delinquent, percentage of auto loan balances. Yesterday, we are at nearly 5%. And if you think about it, 5%, that sounds like a low number, but you can see historically where this has gone. Not a good sign. The growth is clearly there. Also growing, 90 days plus delinquent auto loans in the billions of dollars. This has never been this high before. This goes in line with what we're seeing with student debt and every other form of debt. People simply accumulate more and more as time goes on. Now, speaking of debt, 10-year Greek bond yields have hit a historic low. Look at this. You are seeing it under 1%. During the sovereign debt crisis, during the peak of what happened with Greece, they were at, maybe 38%, and now today, 1%. There's no risk. Don't worry about it. Everything is just fine in Greece, even though the problems from those years ago, which I can't believe it, it's almost a decade ago, are still persistent today. And I don't care who says any different. Hong Kong's GDP is contracting and you can see what's going on. Obviously, they've been struggling for many, many months. Different issues popping up. Right now, this particular corporation cuts February rents by up to 50% for most retail tenants. They want to make sure everybody stays put. They know this economy is hurting big time. And we're talking about big brands here. From Coach to Zara, they're cutting rents from 30 to 50% because it's going to have a major impact. You can already see what has happened. Hong Kong retail sales value year over year is declining severely. The contraction is very real, just like we've seen with so many other factors. Federal taxes and spending set records through January, but nobody cares. Nobody cares about what's happening. And why? Retirement millionaires surge to record in a roaring market. That's right, people with at least $1 million in their retirement accounts reaches a record. People are so satisfied with this market right now, and they have been unable to see reality because they look at that pile of cash, which of course is like a pie and eventually runs out. Maybe it's in 50 years from now, maybe it's in 100 years from now, but the pie eventually runs out. Well, they don't care because they don't see it like that. But I guess we're overreacting because Bill Dudley from the Fed had this to say. Fed's repo response isn't fueling the stock market. That's right, you might have seen this already, but it's true because the Federal Reserve is doing work for the greater good. They're trying to rescue this system. They're trying to save it for you because they care about your retirement. Oh, no, that's not the reason why. It's because they want to support the system to help their friends. That's why, right? Oh, right. I mean, in 2008, things kind of didn't work out that way, and it seemed like everybody got screwed except for an extremely small group of people. I think that might be some information people want to look at. Oh well, that's all for this video. If you found it informative, hit that thumbs up button. If you didn't like it, hit the thumbs down. If you want to learn about how to sell on Amazon, if you want to understand e-commerce, this is a free, 100% free e-course that I created for my subscribers on purpose, the AmazonGPS.com. If you want to know what the financial system is all about, top to bottom, I'm talking everything in here. I've got all the details in these two books. Check them out at the link in the description. If you want the audiobook, moneygps.com. Have you seen this video? You made it this far in this video here, but have you seen this one on the screen? If not, definitely click on it. I'll see you there.